Welcome to Sparta Market Outlook, your go-to source for the latest oil market trends, insights, and strategies. In this podcast, Sparta's team of analysts and experts break down complex market information into actionable, forward-looking insights, helping you make informed decisions in a volatile market. For traders who want to anticipate future pricing trends and seize opportunities before their competition, Sparta provides real-time, actionable market intelligence. For more information about Sparta or to book a demo, visit our website at spartacommodities.com. Now over to your host, Sparta co-founder and CEO, Felipe Sherman.
Okay, welcome everybody to a new episode of Sparta Market Outlook. Today is a special day. It's Liberation Day. And I guess everyone is extremely excited about it. I'm surprised you guys did not take a day off to, celebrate with your families the final emancipation of the U.S. versus the rest of the world. Let's see how it happens. If it happens, how, when. It's all a big mystery inside a riddle, but it's fun and games, and we'll discuss about all of the impacts of this. And today we are joined again by Neil. Neil, hi. Sorry, you're coughing at the same time. Hi, how are you?
I'm good, thanks. Yeah, it's 9 a.m. It's nice. It's a nice change. My brain is not mush yet, whereas normally we record at 3 p.m, and my brain is mostly mush by that stage. So that's nice.
Excellent. Phil, hi. How are you today?
Good. I'm the other way around. I'm still a bit groggy, but let's see. We'll be fine.
Excellent. And today we have also Hua coming all the way from Singapore. Hi, Hua. How are you?
Yes, how are you? I'm the other way around, where my brain doesn't really work until I say 9 p.m. So that's when my brain is the most active. So
that's why
Phil and Neil.
You do realize I'm your boss right now, no? And if you tell me that you only start working after 9 p.m. or your brain only start working after 9 p.m., it's not a very reassuring thing for me.
But it's a question of productivity. You may work 1 hour, but the productivity is the equivalent of 5. So
okay, I'm gonna start paying you only 1 hour. Okay. Anyway, so Liberation Day. We have to start with macro, of course, today. Neil, give us a rundown of the latest events. Yeah, let's start with a quick summary recap, if you don't mind.
Okay. The news, or at least reading the news yesterday, it seems like there's still a lot of uncertainty as to what this will pan out to be tonight. 4 p.m. Eastern time is supposed to be the event. And there's a lot of rumors flying around about what form it could take. So it could be this reciprocal tariff plan. It could be a tiered system. It could be a flat global tariff, and countries will be able to phone up Trump and try and negotiate things lower, which is amazing, I suppose. I don't really want to talk about what the impact is going to be because we don't know what this thing is. Obviously, it could involve oil trade. It looks like it will involve some oil trade somewhere. So we're going to have to do a post-mortem on that tomorrow and next week's pod and things like that. But I wanted to mention it obviously because it's obviously very relevant, but it also adds to my sense of confusion. So one of the things I want to touch upon is I'm very, let's say, confused about where the market is going on crude at the moment, and I'll kind of run us through why, and maybe we can decide on something at the end. Anybody else want to add?
I mean, there's an element of confusion, and for sure, and I think you're not the only one. That if we break it down, what are the most important factors that really we need to be looking at? Is it percentage? Is it secondary, what they're doing with Venezuela? What do you think is the most important thing that, when the news comes out today, that people should be focusing on?
Well, there's multiple angles, right? So the very initial impact on equities, I suppose, is relevant for oil.
Mm-hmm.
What that's going to do in terms of flat price. Flat price has obviously been up the last couple of weeks on geopolitics, because the other thing that happened in the last couple of days was Trump started to threaten the same type of secondary sanctions on Russia, on Russian oil. So I guess the initial thing is the initial impact on equities and flat price. Then there's the sort of longer term impact about what this does to global growth, global trade. So I can see a scenario where the tariffs are, let's say, not as strong as people think they might be, and that ends up being kind of bullish as well.
Yeah.
There's a few different scenarios here, and then of course there's the physical impact on oil. What exactly is the tariff setup going to be against the EU, for example? And then there's the secondary tariff stuff against Venezuela, Iran, potentially Russia. I mean, there's so many moving parts.
So today, I mean, what is it that we don't know yet? I mean, we know there's certain tariffs that have been announced, but today, what are they announcing, like the final program? This is it. This is what we're going to do for the next months, or what is happening today? Or it's just or they're just today is the first day of the implementation of what they have already announced.
Yeah, the implementation will be tonight, midnight, and whatever they announce is reportedly going to be implemented tonight. And that could be there's a wide range of scenarios as to what that could be.
So they're only announcing the details. They're only announcing the details at 4 p.m. Eastern time. So, it's going to be late our time already by the time we know anything.
Okay. But that's what I mean, so, they have already announced certain tariffs and things like that. There is a new set of tariffs that they will be announcing or clarifying perhaps today, or maybe not, again, as we don't know. But my point is, should we be focusing on, is it the secondaries? Is it the percentages? What is the main thing that you think will be the element that will say, well, actually, 25% that was already priced in? What was not priced in is, for example, the secondary, tariffs. What do you think is the element that will make the market say, well, this is bearish or this is bullish?
I think the main element is the kind of macro implications from the tariffs on all of global trade, because I think to a certain extent the Venezuela secondary sanctions are sort of priced in, or at least halfway priced in just now.
Yeah.
And those should go into effect today or tomorrow officially. Iran, don't know much more on that. Russia is going to go back and forth. Obviously, that's related to a Ukraine deal, all these threats. So let's discount that for now. So I think the main issue tomorrow is the perceived impact on global economic health.
Yep. Okay.
And there's probably still some potential for a surprise on exactly kind of what's included in terms of the sanctions on Canada, potentially Mexico, and the EU. Then in terms of actual product spreads and how we need to how product markets might need to react very quickly, because there might be some curveballs there that we'll get to it when we talk about gasoline, for example. But we're starting to already get these deals that are done with tariff clauses in now, so that they can be unwound very quickly if tariffs are actually announced. But it just adds a lot of uncertainty to any kind of product flows both into and out of the US.
Is that true? Okay, I never heard that. So people are not doing deals that are sanctioned. There's a sanctions clause or sanctions or tariff clause.
Tariff. So it's specifically on. We've seen a couple of them on RBOB cargoes, where essentially they're putting those cargoes together, but there's a tariff clause in there so that they can kind of not take delivery. It's also kind of quite last minute.
Okay. Wow. Okay. Well, that's gonna, as we mentioned last week, this is part of this whole rhetoric around peak trade. It definitely slows trading, or slows your ability to take positions and to take risk. Yeah, for sure. But I mean, at the end of the day, I think that all of this is a way to get people to negotiate. It's a tactic to say, okay, we have to renegotiate terms, and so I'm imposing the tariffs, and now you need to come back to see me and ask for forgiveness if you want, and let's figure out a deal. So in a certain way, this is my humble opinion, you cannot start with something that is completely unreasonable, so that you antagonize the other party to such an extent that they ego gets involved, and you just basically are slapping tariffs one next to the other, and it's just an escalation. So this is my personal bet, is that it's still going to, I don't really see them doing much more than what has already been announced, and the secondaries and things like that. That's the real danger, because it will involve India, much more China, etc. No, I just don't see that happening personally. I think that it's going to be annoying for everyone. It's going to be a slap in the face, but it's okay. This is the new norm, and if you want to change, then come and see me and let's negotiate.
Yeah, that's one way of reading it. There's lots of different ways. We've discussed this separately amongst us, Juan and Phil. I mean, there's other ways that people are reading into it. Trump sees tariffs as a source of revenue and wants to reduce taxes at the same time. The efficacy of that is doubtful. Trump, what's the other one? The other one is
basically creating a sort of like a very confusing situation for everybody around, which is it could be the actual objective of the whole like tariff regime, just throwing chaos everywhere. And and obviously we had that kind of devaluation of the dollar theory that we talked about before, which I think it's actually quite an interesting theory. Whether it's going to be true or not is nobody's going to know, right? But
yeah, that's another one. Devalue the dollar to help your debt problem, right? Which yeah, fine, maybe.
Because if you think about it, the sort of like the best way to kind of do that is to throw chaos everywhere. You make everybody around the world just so confused and kind of so uncertain about what's going to happen in America. And instead of people hoarding the U.S. government bonds, you may have people, say, don't keep so much of the U.S. treasuries in the bonds in your reserve. Start selling it, etc. So this, I think.
Well, that's negative for the U.S. If everyone's, with the amount of debt that they hold, they're issuing, you want people to buy your debt, and currently, China, Japan are the two biggest holders of that U.S. Foreign holders of U.S. debt. So you don't want to.
Correct.
You don't want to create uncertainty.
But then you run into you then, because of that, which is what the US has been doing for so long, given that the US dollar has been a reserve currency since World War II. You run into a situation where the US is sort of it's free for the US to borrow sort of like in an unlimited fashion, and that's what they have been doing for so long. And now you have a massive like debt bubble. So not debt bubble, but like massive debt in general. So it kind of works to kind of, if you want to reduce that, and also because when you have a lot of people selling US dollar bonds, and please correct me if I'm wrong, it's been a while since I did my macroeconomics back in college, but you also devalue the US dollar in a way through that kind of process, which helps with say, for example, exporting American stuff, which is what Trump wants. So
yeah. No, you're making yourself more competitive for exports, and you're reducing your trade balance deficit by doing this.
Exactly.
But on a bond holding situation, the uncertainty that you create, and then it becomes a liquidity issue, because I get the long-term picture, but in the meantime you still need to finance the debt, and you need people out from outside to finance that debt. So it's
you're also
it's a balancing act.
You're risking just underlying growth, right? You still need your economy to actually perform, to be able to finance these kind of things. And I mean, I think the flat 20% tariff that has been talked about on just all goods into the US, I think some people in the Trump administration think that that's going to bring in somewhere between $2.5 and $3 trillion over the next 10 years if they keep it in place. But and that's kind of the attractiveness of looking at that. But it's very difficult to justify those kinds of numbers, because it assumes that just everything continues flowing as it has done now, just with an extra 20% tariff on it.
I think what we're going is that this is the kind of brain surgery or brain surgeon that's required, but we potentially have a butcher who is doing the operation, something like that.
That doesn't sound very encouraging. Anyway, let's move on.
Yeah.
We also have, we also hear that Russia closed 2 out of the 3 SPMs out of CPC Novo. Is that the case for inspection? No, I understand. Well, that's the official version.
That's the official line. They did this a couple of years ago, and these things are important, right? So the CPC exports are pretty big, over 1 million barrels a day, well over, and they need 2 out of 3 buoys to operate, or SPMs to operate, and so now there's only 1. So there's talk of, if this continues, it's going to have CPC exports basically, which is pretty bullish. And there's a few, we'll see what happens. It's a sort of developing story. It might be in retaliation for US statements. It might be because Kazakhstan's been one of the chronic overproducers in the OPEC group. So, yeah, I think it's quite bullish. What's annoying is that this has happened at a time when the physical crude market, let's say, seemed unjustified from a physical perspective. And that's what I was going to talk about today. But then this news broke yesterday, and now it kind of muddies the picture a little bit. But we can get onto that later.
What do you think? So what is the volume that is attached to this, you think? Is around, 500?
It depends, because I think you can also reroute via some other pipeline systems. But yeah, I think it's at least 500,000. It might be 800 kbd all told. It's pretty big. It's huge, actually.
It's very big, yeah. So what do you think? Well, what has been the immediate market response?
Not that much. I mean, flat price was reasonably bullish yesterday. But the problem is that spreads were already huge. Crude spreads were already huge. The DFL was already huge. We can talk about the DFL later.
Yeah.
So I'm not sure that's a good position to buy, let's say.
Oh, let's look at, let's wrap up a bit the macro, and then let's go into the details of crude, and then we'll move on to gasoline afterwards. But I think it makes more sense to just move on directly into crude based on what's happening, no? But I mean, we do see quite a lot of bullish signals out there. This news just adds on top of what we're hearing in the world of uncertainty around tariffs and things like that. And again, these are not minor suppliers. Russia, Venezuela, well, to a lesser extent, but obviously Iran. What we've seen so far is that with direct sanctions, basically India and China did whatever they wanted, and they continued. That oil continued flowing. It just went to different regions, and there was a misallocation of barrels, or it was a reallocation of barrels, but they were all flowing all the time. Now, if you do have these secondary sanctions, then begs to question whether India will continue buying, whether China will have additional pressure, because again, we're talking about tariffs on all of their traded goods, right? So it becomes messy. So in that environment, I'd rather be long than short, for sure. If you add on top of that all of the things that are happening, the SPMs, all of this sounds very, very bullish. Now, given that, can we talk about the physical crude market? And maybe you were saying, Neil, that you're very lost. Why are you so lost, and what do you think needs to be resolved in order for you to have a bit more clarity?
Well, I'm lost because some of this bullish news is kind of ephemeral, or it's not really materialized into anything yet, right? So that's one thing. So the sanctions, the potential secondary tariffs on Russia, we could talk for an hour about whether we think this will truly happen. So it's one thing in terms of it's probably part of a deal or negotiations, if you like, on Ukraine. So Trump was angry at Putin and blah, blah, blah. And then you need to think about, it's a huge volume of oil. Like, this is a whole different ball game from Venezuela, which is, 500,000 of exports or something, or a bit more. Sanctioning Russian oil would just be black swan event for flat price of crude. And yeah, probably India could stop buying, but then, the discounts for the Chinese would be huge. I'm not quite sure where this goes. But yeah, if it's all additive, if China continues to take Venezuelan, Iran, and Russian, there could end up like 100% tariff on Chinese goods trading with the US. I don't know where they stand on that. It's okay. But anyway, back to this. A lot of this stuff hasn't materialized yet, so we don't know. It just sounds bullish.
Yeah.
The other thing that's happening now is, so specifically in the physical crude market, the DFL has been trading at basically plus $2 per barrel, almost the April DFL. That's the type of situation, that's the type of level that you saw immediately around the Ukraine invasion, when flat price was going up to $120. And we were pricing in a severe impact to oil supply. So whilst this is happening earlier in the week or sort of on Friday, I was thinking, I don't understand why this is happening, because fundamentally, what has changed, or why is this justified? And talking to a few people, there is some kind of dated, complex play going on, right? So the dated Brent and also to a certain extent the Dubai market are susceptible to majors coming in and having a physical position and an opposite position on paper, and they can make things work from that perspective. And I think that's what has been going on in the dated Brent market and the DFL over the last week or so. So I was basically just saying, well, look at the ARB perspective, this thing must collapse because Brent is not competitive anywhere in the world. TDI has been landing very cheap into Europe, so I think this must collapse. And the fundamentals, nothing's really changed. Mm-hmm. So I still, to a certain extent, think that, but it doesn't help that you have all this potentially super bullish stuff, and now you have a likely disruption to C2C volumes, which could be huge. Mm-hmm. And then think about Venezuelan volumes might be dropping off. There's some news reports that exports are struggling already. Except that's what you also saw in Iran earlier in the year, and it lasted a few weeks, and then they found workarounds.
Well, it's normal. It takes time for you to find the workaround. If you have a steady trade flow, then it takes time. That's normal. Mm-hmm.
Yeah, and then flat prices has been rising. That takes up ICE spreads. That drags up the whole physical Brent curve. So that doesn't help either, and that's all geopolitics. And then you also have strong TD25 freight rates, which raise the sort of delivered price of TI into Europe. For me, that's what I thought. I just thought this will collapse at some stage, but now I'm sort of losing the confidence in that statement because there are more and more bullish things mounting up. And then the other thing is to look at the Dubai market. So this somewhat the same thing is happening in Dubai. Dubai market is strengthening. There's a lot of activity in the Dubai window from the majors, and to a certain extent, I was thinking, okay, it's a kind of similar play, or maybe they are anticipating something happening on sanctions, and it's not necessarily just the fact that Asian demand is strong, for example. But that's why I don't know where to go. I'm to be honest, I'm confused about where this market is going. I still think it looks somewhat toppy, let's say, until we get more news about, let's say, actual volumes being lost to the market, particularly out of Venezuela and things like that. Mm-hmm. Does that make sense to you guys?
I mean, what you just summarized to me is, it sounds like the classic buy the rumor, sell the fact. As I said, when as a trader, you look at all of these news, you just don't want to be short. That's for sure. Yeah. And then let's not forget that when you look at all of the supply and demand dynamics, or the rhetoric that we've heard from the market for the last 6 months, it was ultra mega bearish. So you have to bear in mind that there are some people that were perhaps short and now are covering and they're buying, and maybe that exacerbates this buying spree because you don't want to be caught short in this kind of market. So yeah. So there's the strategic long-term picture. Which is, or the structural picture that perhaps remains bearish with the physical oversupply, but in the meantime, you want to get caught in that. I don't know. I mean, look, I don't know if it's shenanigans. When you talk about the market, the DFL, well, the DFL is obviously very front month, but are we the fact that you're talking specifically about Brent and Dubai? Those are futures. That's where hedge funds go. That's where the sort of like the financial community goes to express an opinion on the oil market. It is, the theory. Okay, I'm unwinding positions. I'm not going. I'm balancing my position, etc. You will do that with futures. So it's actually normal to see that dislocation between the futures and the physical when these things happen. Now, if it's if it's in pricing, that's a different thing. That's a whole different ballgame, because pricing should theoretically match the physical reality. If it's, but that's, as you say, it's shenanigans. We don't go into those things. We don't talk about it. But anyway, okay. So every time this happens, because this happens in every single market, and it happens at least 3 or 4 times a year, it either can, what you need is to be fueled by more and more news. And at some point, if there's a lack of news, then everything goes back to fundamentals, but until you don't, right now we're still in this news spree, because we're going to have the announcement today, then there's going to be the reactions, it's going to be bearish, bullish, etc. Then you're going to have the counter arguments from Europe, from China, we are still in this environment. And again, this is where, as a trader, this is what I love, these kind of conversations between traders and analysts, if you want, is that you're looking at the fundamental picture. It's like, well, this will collapse because there's just too much oil, this, that, whatever, at some point, okay. But the question is timing, is the timing element. The supply and demand, it just becomes a completely secondary in today's environment. And it will inevitably come back into force and drag everything into one direction or the other. But there's a tactical element of it that we cannot forget, or maybe even emotional as well.
Well, we have had a good run of bullish news, right, on crude, or seemingly bullish news, and now, as you say, now we're about to get the tariffs, or the sort of global trade tariffs. Maybe we get a kind of bearish run of headlines over the next few days.
Yeah. It's possible, yeah. It's possible, or not. That's the problem, is that now it's very macro driven. But you still need to keep an eye on the physical market, on the ARBs, and on the fundamentals for sure, because ultimately there's two ways of making money. The flat price or the spreads, the cracks, the physical, the ARBs, and all that. Your day-to-day business, for sure. So it's so easy to fall into the trap of just looking at what Trump says, and because that's where the big volatility is, and therefore the potential big money or big money losses.
Yeah, and on the fundamentals, just to make clear, like I'm just saying, like a DFL of +2 is sort of war zone territory or huge volume loss territory. That's why I'm kind of bearish. But we've been saying for weeks the fundamental picture is not loose, right? Yep. So, and the timing is now kind of difficult because European turnarounds are now ending. They should be buying more crude. Asia is kind of just peaking, but maybe in a month's time, the buying will start to ramp up. And there's not that much in inventories data that tells you that there's lots of oil around. So that makes things difficult as well. I don't think we should be in contango or anything, but maybe we're just not justifying this strength.
Fair enough. No, fair enough. That again, you have market exacerbations and extremes. You hit some extremes because everyone is funneling into a certain position all at the same time, and then it dissipates and we go back to sort of normals. No, for sure. But look, I mean, it's as you said, if the fundamental picture is not as loose as people said or have been saying let's not forget, everyone was talking about 1.5 million of excess oil or 2 million barrels a day of excess oil. Everyone was bearish. And then it was like, oh, well, you know what? It's, first half of the year is actually not that bad, but then second half it's going to be dramatic, and we keep kicking the can down the road. And, as you said, the stocks are not that bad. The situation, physical situation is not that bad at all. And now we have all of these elements, Now, $2 DFL, yeah, I agree. Maybe a bit exaggerated, yeah. But, okay, that's... So, are you a bit less lost, or what do we need to see to be less lost?
I would prefer that the DFL gets sold off a bit.
Okay.
And maybe ice spreads as well. I'm sticking to that. I don't see what else I can do. I don't know if I would be further along at this point in time.
Okay. And in Dubai, the spot MEG diffs are fairly strong as well. Is that also based on, macro, or is there a physical story behind this as well?
Well, yeah. Well, the spot diffs are rising. They're not super strong like we saw earlier in the year. They're up by 50 cents or $1 in the last week. That's not nothing. But yeah, it's difficult to know. Is this like a front running of expectations about sanctions or tariffs? Is this a kind of window, trading amongst the majors, which there's talk of this week as well? So, and Asian turnarounds are they peak in June type thing. So
we're almost past that in terms of buying now, right?
Well, we're doing June loaders, so sort of. But remember, that's the peak of turnarounds. It's not zero turnarounds.
Yeah.
So, yeah, I don't think we're out past the sort of weakest point. Or maybe we are, but we're still not in full run mode, let's say.
Okay. Anything else to add on the physical crude side of things?
Well, yeah, 1 minute. So WCS diffs are really tight. That could be a number of different things. It looks very tight. It's sub $10 per barrel, -10. But the other thing is there's oil sands maintenance at the moment, so that impacts the actual physical availability of this crude. And maybe there's some front running of tariffs in case it does happen. So it's maybe a slightly not the best indicator of the real physical conditions over the medium term either. And one thing just to point out on the Dubai market is that the OSPs are due out soon, and those are expected to drop by $2 per barrel for Arab Light in Asia. Okay. So that will help the situation in terms of term crude will get cheaper. It will improve the margins a bit on paper. That's it.
Okay. Not bad.
Half an hour later.
Yeah.
Sorry, guys.
So, Phil, moving on to gasoline. You've been quite bullish, gasoline spreads for the last couple of weeks. Well, it's not like we had a massive increase, but you were right in the call. Tell us more about that.
It wasn't probably rocket science to say that a May-June spread that was at zero should probably strengthen a bit. And so, we've gone from 0 to about +5. And I think kind of 2 months ago, I said that by the end of March, April, May, we would be back at parity. We would get rid of the contango in that April, May. And that happened at least on the 1st of April. So I was a day off, but April, May is now at just about almost +1. So that was that played out, and it was justified because we had some bullish impetus on ARA blending. So ARB was open, and it was just looking a bit too weak. Now, the direction through April, I'm a little bit like Neil in this respect. I'm a little bit uncertain. So I was much more certain 2 weeks ago, and I'm much less certain now. So actually, I was going to kind of throw this back to you a little bit, Felipe, and say I'm going to lay out the parameters for how I see the next.
Is this a new game? Right, we have a game now. Okay,
we have a game.
Give me the parameters. I need to give. Do I have like 3 choices or?
Let's see. So essentially, prompt ARB it has been open for the last week or so. It looks open through April and into May as well. So it's moving around. Like whether the blender margin is open or not, kind of moves around hourly, but it's essentially workable. Gas snap has widened quite significantly over the last couple of weeks. We're now at kind of plus 110-ish, and we were at kind of 80 or 90. But the reference premia haven't moved at all in that time. So we're having this kind of widening disconnect between the paper gas snap and the actual physical reference premia, and some of the other components in ARA are not really moving up. Open blend margin, so open EBOB blend margin throughout April. So again, should be bullish pull on components. And out of ARA, we've got open opportunities into Canada, Brazil, the rest of the Atlantic Basin. All looks like it's pointing towards ARA. So I think we're relatively bullish components demand, but with that open EBOB blend margin, I'm struggling maybe to get too bullish on, let's say, May-June spreads.
You say is the blend margin of EBOB is positive right now as well?
E10 yes, E5 almost. Then just a little curveball which I thought was interesting from our seasonal tables and was slightly confusing to me, but the May-June spread almost always softens through April, which feels kind of slightly counterintuitive for a seasonal perspective when I thought demand should be improving.
Yeah, but it's this that's there's a reason for that, is that you get a bit, market gets a bit eager to buy the April SEP and May SEP spreads. You want to buy summer in general. That's the driving season and all that. Mm-hmm. Maybe market gets a bit too excited and then it sort of comes off. It depends on how you start the season. Here we haven't really started. April Now it's flat, but it was it was not like a very bullish picture. I would not think that we are in like the typical historical scenario where people got overly excited. It corrects in April, and then you start seeing a bit like what Neil was mentioning before, is that the market is expecting something. The physical reality is not demonstrating that. It sort of collapses, and then the physical reality kicks in, and then people saying, actually, I was right. It was just the wrong timing. Look, from what you're telling me, I think that goes back to what you said before about these contracts where people still want to trade, but they want to have the option to trade, to get the opt out, if you want, of a deal in the event of tariffs. I think we'll know more tomorrow or tonight. But in this scenario, again, it goes back to uncertainty. First of all, let's say, even if the ARBs are open, if maybe only 20% of people are are willing to trade these ARBs without certain certainty, especially if the ARBs were open by $3, I don't know, $10 a ton, $20 a ton, or whatever, then I would take the risk. Let's just let's lock in the ARB and we'll see. Okay. But if it's just barely open, and when you say barely open, is including tariffs or excluding tariffs?
Excluding tariffs.
Excluding. You see, so I would not. So these are, it's giving me a theoretical indicator that that if the tariffs don't happen, then I'm fine. You see, right now it's wait and see moment. It's and market was a bit too negative, and that's why you see that the market on the paper side has gone up a little bit, but on the physical it hasn't. So it's more like buy the rumor on the gasoline side. And again, gas naphtha is generally you always have a weak leg and a strong leg. And generally speaking, gasoline is the sort of like the strong leg, and then naphtha, well, not strong, but the leading one and the lagging one. And generally it's more gasoline, the driver of gas naphtha, let's say. Now people are not willing to be a bit buying the rumor kind of situation, and which is driving gas naphtha to go up. But on the physical reality, no one is doing anything right now. Pretty sure that if we called physical brokers, they would be very, very bored, and right now.
Yeah, it's unusual to have seen so little movement over the last week or two in those component premia. They've been very, very flat, and the news from the physical brokers is that there's just not a whole lot of activity going on. So it all kind of lines up, and I suppose so. On paper, it looks as though it should be constructive, but I think a lot of people got burnt post IP week. Everyone got together in IP week and decided that actually, there needed to be a bit of a sell-off. So people are hesitant potentially.
Sorry, I have to interrupt you there. No one decided anything. Let's not get into conspiracy theories. We're not that kind of shop. We don't. People did not decide anything.
That way. I mean, in terms of kind of broader market sentiment, but no. I think there's hesitancy to get actually bullish from multiple angles, right? So people got burned, and we have tariffs ahead of us, and we do also have a physical picture in Pad 1 at least, where we've had Bayway's been down for a good few weeks now, and inventories haven't really drawn as we would expect them to, or actually just Pad 1 inventories in general look pretty strong still, comparatively strong. So in terms of kind of supporting then later in Q2, supporting that open arb is it's all very uncertain. It doesn't look as though demand is fantastic at the moment.
Okay, yeah. So look, I mean, in that scenario, you want to go back to sort of normal kind of levels where you're neutral, balanced, and wait and see scenario, I would say. Gulf Coast, what is the Gulf Coast telling us right now?
Yeah, so Gulf Coast had a bit of a run up. So it was looking quite weak, and then we've had a situation where the ARBs looked open, and the component prices rose. Now we've got kind of runs. You had 3 runs ticking up. TC14 has moved up higher, and so we have fewer outlets again for the Gulf Coast. It seems to be kind of much more balanced. It got helped by the fact that the wholesale margins opened, so the wholesale blend margins opened, so that kind of shored up the component market in Pad 3. But now it looks as though we're much more neutral kind of territory, at least. And then looking into Singapore, we're a bit more constructive again on an arb perspective, but that's looking into the details. It's mostly because the landed prices of the cargoes that are coming out of India, that are coming out of China, have come off a bit. So it looks as though there's more material around in Singapore that's a bit more kind of economically viable to blend. So that should be putting a bit of a supportive kind of floor, at least under Sing spreads, which had run out of steam, as it were, recently. And we still have a number of particularly RFCC outages in Asia. So that, on a supply perspective at least, is helping to keep that a little bit propped up at least.
Fair enough. So to summarize the gasoline picture, a lot of it still is a bit of wait and see. Unlike in crude, we don't have any kind of, let's say, unrealistic prices that are not necessarily misaligned with physical realities, etc. So there's not like a short-term tactical trade to do, but essentially we're pretty much in wait and see territory. No?
Yeah. I think maybe the second half of this month will get a little bit more active.
Awesome. Moving on to distillate. Now, distillate, from what I understand, is the biggest loser right now in this sort of market uncertainty relative to what we've seen, for example, with crude, with gasoline. Is that a fair assessment? What are you seeing?
I mean, based on price movement from yesterday, at least, yes. So if we're looking at kind of gas oil crack box, for example, that has the next 3 months of that. We're in backwardation last week. They're all in a fairly solid contango. So the underlying spreads in gas oil have weakened beyond what we've seen. Obviously, crude has gone the other way. So actual gas oil spreads are still in backwardation, but the crack box is not. Just about, yeah. The crack box is not. And we've had also then the physical market. So the CIF market in ARA has also come off almost about $5 done this week. So what that's meant is that because it seems to have been expressed mostly in ice gas oil, this weakness, so HOGO has widened, East-West has not really moved too much, but the physical market has also come off in Europe, which means that on a physical reality, we've seen very low flows or relatively low flows into Europe so far this year, and the economics to deliver into May now are also very, very weak. So you're still going to have kind of these baseload flows into Europe maybe, but it's really signaling to not take anything more than the absolute bare minimum that it needs to, essentially. Though all the swing kind of AG Indian barrels are all pointed very kind of decidedly east. The Gulf Coast arbs into Europe have the last day or two really come off as well. They have options into Latin America that look as good, if not better, than the options into Europe. So it's difficult to see gas oil justifiably falling further from here, especially kind of in comparison to heating oil, in comparison to Sing. But as an expression of broader kind of bearish market sentiment, then maybe you do get gas oil selling off a bit more. But from a physical perspective, it doesn't need to. It's already shut off, any kind of marginal arb into Europe.
So it's very much a question of a demand shift. If you do see a demand shift, reduction of demand as a consequence of all these tariffs, etc. So is that what people are anticipating? And therefore, despite that physical picture that we're seeing right now, where there is no resupply coming into Europe, people are in a way bearish because of the potential
demand
impact.
Expectations. Yeah. Okay. And I think kind of gas oil is, correct me if I'm wrong, Neil, but typically or historically the one that follows kind of GDP expectations most closely, right?
Naturally, yeah.
Cracks, yeah. Cracks, I would say.
Yeah, rather than prompt spreads, obviously, but
and that's a fun one because Asian, just to interrupt, the Asian margins, refining margins are not that healthy still. So if you get another, let's say, $3-4 off the gas oil crack over the next week, then we're talking kind of negative cracking margins on some of these medium sour crudes into Asia, and that's a bearish signal, right? That's an expectation on the longer term happening on cracks, but it eventually will tighten up your physical market so that leads you into the thinking that, that eventually this thing needs to rebound quite quickly. So that might be a fun one just to watch out for.
Yeah. Okay. So again, I think that we need to have another podcast once we have the news, tomorrow, and because right now there's a lot of wait and see going on. Yeah, that's for sure. Anything else to add on the distillate picture, Phil, or should we move on?
I think before everybody kind of runs out of gas, as it were, let's get onto the resid.
Nice one. Juan, tell us on your side. So let's change a bit the dynamic and not only talk about the US, but there was a story around China export quotas. Is that the case? Can you tell us more about that?
Yeah, definitely. Well, I mean, if you take a step back, so in China, you already know that to exporting this sort of petroleum product, you need a permit from the government, and then you are subject to sort of like individual company export quota. So everybody would have their own export quota. PetroChina would get this much, Sinopec would get this much, etc. And also the sort of overall export quota, and that goes for your clean products and your dirty products. And the quota is usually they kind of release it in batches, which, I mean, the argument behind that is to give the government a little bit of time in between the batches to kind of assess and potentially adjust them to what they think is appropriate considering their overall policy guidance. But of course, what they think is appropriate is nobody really knows what they think is appropriate, right? So what happened last week is that we did see the release of the second batch of export quota for the year. So that was, I think, close to 13 million tons for clean products and then another 5.2 million tons for dirty products. So overall, it's like 18 million tons across all of the products. China rarely ever exports high sulfur fuel oil. So most people often call this, 5.2 million tons allocated for dirty products, the so-called low sulfur fuel oil or LSFO export quota. So when you hear like LSFO export quota, technically is for all dirty products that could fall under that export quota. And across the first two batches, we did see a little bit of an increase in export quota year on year for LSFO. I think that was around like 10% or something. And one notable thing that many people have already pointed out in the market is that from the start of the year, I think China combined the two. Like for every product that you want to export, import, you have like an excess code that you use to clear customs. So back in the day, there were two of them. So one is the so-called, well, actually there were one too, but one was the so-called other diesel oils and other fuel oils, which was used to, for exporting or importing things that would also include, like marine gas oil. And then you have the other HS code that used to be called the number 5 to number 7 fuel oils. So that was the traditional code used for exporting or LSFO. So from the start of 2025, they combined the two HS code together. So effectively it's just one now. So whether you export a fuel oil or the MGO, your marine gas oil, everything falls under this one kind of HS code. And so so that's kind of like the quick rundown of what happened with the export quota last week.
Okay, so the biggest impact being on LSFO. But I forgot to ask you. I should have started with that. But actually, last couple of weeks you've been quite bearish on the physical market and the spreads, and at least that's what you were mentioning on your market outlooks. How does that turned out, and what do you think has happened?
Yeah, I think. Are you talking about the high sulfur complex? I think there were kind of like multiple calls that we make. I make one very bearish call on low sulfur back in like February that turned out to be
no, I'm talking
true. Okay, so the high sulfur, the last
the
one.
High
okay.
sulfur, yeah. Mm-hmm.
Yeah, well, trading high sulfur is always a very tricky business, right? I don't know about you and gasoline, Felipe, but the high sulfur complex has burned more accounts than anything I've ever remembered. So since 2022, there's obviously a lot more that we don't know about the complex than what we do know. Mm-hmm. So I'm always very, hesitant, very reluctant when it comes to calling anything high sulfur. But about 2.5, I think 3 weeks ago, I wrote in a market outlook. I make the argument that in the short run, the odds kind of favor the downside for the high sulfur complex a little bit more than the upside. Caveat obviously being stocking season for summer burn in the Middle East is starting shortly, so that was a caveat. And the reason for that kind of like a short-term bearish call was that back then we saw quite a number of things within the blender that we run for the high sulfur. First thing back then was that the main blender, which uses only the purely non-sanctioned component to the calculations, were showing very positive margins for the blenders in Singapore, and that's actually very unusual. You would remember we talked about this on the previous podcast, that this is using the purely non-sanctioned components, and it's usually the case that they make like they don't make any positive margins, usually at a small negative number. So of course, it was very unusual to get this sort of positive blend margins for these blenders in Singapore. So that's massive incentive for all of these, guys to kind of bring out as much supplies as possible. And then we run the same calculations, which kind of, if you looked at it, it kind of suggested a market that had priced very little, and I really mean very, very little Russian molecules, making it into the blend pool, which I don't think, is the case in reality. And if you think about it, the strength in the complex seemed to be resting on this, one little hinge. At the same time, when you have the peace talks in Ukraine going on, and then the potential sanction relief was sort of becoming a real possibility that everybody should, take into account. So those were two main things that we saw back then. And then we also looked at the break-even blender, which I think it was showing that you have all these like mid-sulfur components in Asia, the Taiwanese stuff, some of the Korean stuff. Most of the time they go into the low sulfur blending pool, because usually that's where you get a lot better value. But 2.5 weeks ago, when we looked at the platform, we saw that these mid-sulfur components were starting to be in the money into Singapore high sulfur blending by like say $20 to $25 per metric ton, which is it's something that doesn't happen very often. So when you see that, you're like, okay, hey, it's interesting. So it's unusual. It's additional supply that is kind of coming into the high sulfur pool. So we take all of this into account, and obviously I make a suggestion to our clients that, hey, if you are long, it's time to exit. You may miss a little bit of the upside, but it's better for you to not reach the tippy top than to get caught in avalanche, right? So if you're long, go and exit. But if you don't have a position, I think the odds back then at that exact moment kind of favor the downside a little bit more than the upside. So
and that was and since then the spreads, I see that 380 spreads went from 23.50 to 13.5.
That's a physical. That's the physical premium.
Sorry, the physical premium. Yeah. And the April, May from 650 to 350 over the last 2 weeks. So, I mean, that's again going back to this combining the physical reality with the macro. Macro is driving the picture right now, but the physical reality sometimes still has a very influential. Will always have an influence in the market. It's just the timing of when it does, no? And in this case, seems like it was the case. Yeah, definitely. Particularly when you start getting to these kind of price levels that are completely outside of the norm. If you're telling me that these mid-sulfur products were arriving in Singapore with margins that were absolutely outside of norm, then you can have whatever you want in the macro picture. At the end, the physical still has the impact. No?
Correct. And funny enough, if you remember, just I was like, hey, we looked at the break-even blender, and it was showing that some of the mid-sulfur components were roughly around $20 in the money into Singapore high sulfur blending. And then what happened is that the week after, I think the week after, or maybe the week even after that, the Taiwanese materials that I mentioned, the MCB and the CFB, were actually sold into the high sulfur pool. So and MCB in particular, which is your kind of like your slurry coming out the RFCC, it got sold, I think, roughly $20 stronger than the previous cargo. So it's kind of like roughly where we were expecting it using the break-even blender. So it's sort of like, well, sort of advertising for our tools, right? But
it's proving to be a very powerful tool, really.
It is proving to be a very powerful tool, exactly. So
Can I ask it? Sorry. Okay.
So guys, I'm terribly sorry. I need to run. But I know, Juan, that you had a lot of more things to discuss on fuel oil. I'm going to be very rude, but I'm going to leave you guys. Neil, can you continue with the questions around fuel oil and all that?
I can.
Okay,
Let's go for it.
See you guys. Take care.
Enjoy.
Thanks, Felipe. See ya.
Okay, wow. So from talking to some of our customers, especially those in Europe and the US, we noticed there's a bit of confusion over how these quotas actually work. Do you want to just shed some light on us on that perspective?
Yeah, sure. I mean, well, I think this is where like an understanding of the logistical aspect of physical trading is actually really important. Obviously, I'm simplifying a lot of things over here, but within each country, you have the so-called bonded zones where there are special terms and policy when it comes to like trading and stuff. So now when people talk about importing or exporting materials, whatever you see on vessel tracking can be very, very different from what customs actually count as an import or export. Say you have like a Shandong teapot and they import a cargo of Russian straight run, and this cargo goes to China, gets discharged over there, and then the molecules move inland to be used by the refineries. In this case, you see an import on any sort of vessel tracking service, and custom also counts this as an import. So there's no kind of a discrepancy between the two. But say you have a cargo of VLSFO that moves from Singapore to Zhoushan, gets discharged into a bonded tank in the bonded zone, perhaps it gets blended in the bonded tanks before getting bunkered out into the ships. So it will show up as a sort of import of vessel tracking, but it doesn't actually count as import for custom purposes because it stays in the bonded zone. It doesn't really cross from the bonded zone into the rest of the country. And to me, this is a very important distinction that a lot of people kind of miss out on, and then it causes a lot of confusion over which one is which, and in terms of the policy and stuff. So now back to the export quota of fuel oil. China rarely export fuel oil as cargoes, the way you would see it, for gas oil or gasoline. So what really makes up the majority of the so-called fuel oil export from China is the domestically produced LSFO crossing into the bonded zone at like a place like Zhoushan. Perhaps it get blended and then it get bunkered out into the ships over there. So that's actually what counts as the what makes up the majority of the fuel oil export from China.
Yeah, I remember similar things looking at sort of official jet exports versus the cargo tracked exports, right? Because there's it depends on what's counted as
anything that goes on a plane that leaves China counts as kerosene exports. Yeah.
Exactly. So it's the same principle. Like as long as you cross from the rest of the country into the bonded zone, that counts as an export. But you need to cross from the bonded zone into the country to count as an import. So anything that goes, like from outside into the bonded zone gets exported out again, and we go crossing that zone into the country, it doesn't count as anything.
All right. Thanks. And we'll do one more question because it's getting pretty long today, and then we'll do a quick wrap up at the end maybe. So just from the 2 points above, what if the domestically produced LSFO crosses into the bonded zone, but you, as a blender with bonded tanks, take something else from Singapore, for example, to blend with the domestically produced molecules? How does that get treated?
It's a good question, actually. And in fact, that's something that happens quite regularly. The domestically produced low sulfur molecules in China are, very often is something very similar to the RFCC feed, which is closer to say 0.3% sulfur. So there's quite a bit of, the sulfur giveaway there. We just set it off as like VLSFO for bunker. Of course, that's money you're leaving on the table. So what happens is that very often the blenders over there move these molecules into the bonded zone, and then you take some sort of mid-sulfur molecules from, say, the Far East Russian stuff, which is 1 to 1.2% sulfur, and you use those to blend with your domestically produced molecules to make on-spec 0.5% VLSFO. So now, which part of this equation counts under the export quota? It's actually only the domestically produced molecules that are counted under the export quota. So stuff that we talked about, like the Far East Russian mid-sulfur material in this example, actually doesn't get counted. It doesn't get imported and then export it, it actually stays within the bonded zone for blending, so it doesn't count on any sort of quota. So it's it's besides not leaving money on the table as we talked about, it's also a sort of way for you to have a swelling of volume that doesn't eat into your export quota. You produce this much domestically, send it to the bonded zone, you get so that counts under the export quota, but then you blend with stuff that you get into the bonded zone from somewhere else outside of the country. You get more volume out of it without having to eat into the export quota.
All right, good to know. I mean, yeah, you need to write up some kind of document for me, because I frequently forget all these little details of the dark arts of the fuel oil market.
It's confusing. It's confusing to a lot of people, especially if you're not involved in the logistics of importing and exporting all of these materials. So it's.
All right, guys, let's maybe wrap this up. Thanks very much, Hua, for your stuff. Do we want to do a very quick roundup of trades? I mean, we've done lots of stuff today. Phil, do you want to do just a sort of 2 bullet points? Not for Hua, but Phil?
Gasoline is wait and see, right? I think was the conclusion. It looks all pretty well balanced right now. So no strong conviction either way. And everything hangs on what comes out of Liberation Day, doesn't it? So let's see, basically.
Yeah, I think I'm the same for crude. I think I'm sort of short-term, semi-wait and see / slightly bearish. I think I'm bearish DFLs. And just as while I was speaking, someone's forwarded me an article from a news agency talking about a record volume of DFL swaps traded on Friday, and lots of people suggesting that the price action was suggestive of lots of stop outs, basically. So that's potentially why prices have just ripped, which makes me think, this will turn around again at some stage soon, unless something crazy happens.
All right.
That's it. Well, thank you very much, guys. Pleasure to take over hosting duties right at the end unexpectedly. And see you guys next week. Yeah.
See you next week.
Cheers.
Yeah. Cheers. Bye.
Thank you for listening, and we hope you enjoyed the podcast. For more information about Sparta or to book a demo, visit our website at spartacommodities.com.